Give us 30 minutes each week to discover the trends that are shaping the future of retirement with That Annuity Show. We bring you conversations with industry leaders who are revolutionizing financial products, technology, and distribution channels. Now, here's your host, Paul Tyler.
Welcome to another special episode of That Annuity Show. This is Paul Tyler, and as you, if you've been listening to our show every quarter, we have on David Czerniecki, Chief Investment Officer of Nassau, to come on and give us some of his valuable time and insights into making sense out of an economy that is rapidly changing. David, welcome back.
Thanks, Paul. Happy to be here.
I can't believe how fast these quarters go.
I know. You and me both.
Yeah. Well, it's interesting. There's some familiar themes and there's some surprising themes. I guess we steer far away from politics, but I will tell you, I look across the globe, and I think I saw some stats that said like every single global leader who's been up for re-election lost their election this year across the whole civilized world. It's amazing.
Yes, I've seen that too, Paul. And I think one of the things, and again, we do try to our job certainly on the investment side is we have to deal with things as they are, right? But I will say that there had been a lot of publications and research and just sort of opinion pieces and stuff over the last couple of years that have been pointing out this trend of sort of populism, if you will, and you're seeing it play through. You're seeing it in France, right? And you saw it here in the U.S. That it's not unique to our situation.
Yeah, no, not at all. And really, first question is coming out growth of this election, which is, I'm surprised we're talking about it, but tariffs, interesting, very powerful weapon for countries to use. Sometimes it's harmful. Sometimes they can work. And I guess from your perspective, what kind of tariffs, could have a good impact on the U.S. economy over the next couple of years?
I mean, it is tough to say. And, sort of as the economist in me always wants to, be sort of have a free trade mindset and say that that's, kind of the way to go. But having said that, if you go back, it will be, more than 4 years now in the first Trump administration, and tariffs were put on a number of, in particular, Chinese goods. There were some other things too, and some changes to NAFTA, et cetera. But, a lot of those tariffs were not taken off, and it was in part because they were designed not so much to impact trade and trade flows, but more to try to level the playing field in international trade. So in other words, even if you're someone like me who's very much a free marketer who believes that, you should just let kind of the flow of capital go where it's best suited, that's all fine and good, assuming a level playing field. And there was a strong view that some of our trade counterparties weren't playing by the same rules as us, and some of those tariffs were designed to do that. Clearly, they didn't hurt the economy. The economy continued to do relatively well. I mean, obviously, we had the COVID dip, but other than that, the economy continued to do pretty well. Most of those tariffs were left in place, so they're. Just to go as far as to say it had a positive impact, I think that's a little harder to say, but it wasn't harmful. And if you're leveling the playing field and we're all then, sort of trading by the same rules, it has some advantages. Full well, Paul, that there's a lot of speculation in the press that a lot of this is negotiated.
Correct.
You've also seen it, some rhetoric around using it as a stick. For instance, the most recent announcements about tariffs in Mexico and Canada, targeting, immigration flows or drug flows or, and things of that nature. That's clearly a stick, kind of approach. So those are areas where, maybe it's not quite as bad as one would think. And then the other thing that, I would say is that, again, to the extent that it sort of, creates some for lack of a better term, we're balancing the force, right? They can help. Now, just to go on for a second on a little bit of a tangent, I think we have a sense of, some of the harm they can do. They can make our goods less competitive, right? Because there's going to be retaliation. You've heard plenty of noise about the fact that, tariffs can be inflationary because the rising cost of, to consumers, in whatever you're buying. Competitive advantage that the U.S. has is we tend to export more in the way of services and import more in the way of goods. It's harder to put tariffs on services than it is to put them on goods.
Interesting.
So it does give us a little bit of an edge. Now you can close your markets to our services, as we've seen that, right? But it is to just sort of put a tariff on a service is a lot harder to do.
Yeah. Well, maybe we're at a structural advantage at this point in this time in history. Related question. I opened my inbox and read this wonderful prediction from Goldman Sachs that the S&P is going to go up another 10% this year. I'm sure guaranteed, not guaranteed. Primarily due to the tax cuts. And I guess I'd say, like, if that turns out to be true this year, David, what else would have to happen besides tax cuts in certain either certain groups of individuals or certain sets of companies?
Sure. So there's a couple of things at play here, Paul. At its simplest level, if nothing else were to change, a tax cut. Well, to go back to the old adage, it's not what you make, it's what you keep that counts, right? So if you're paying away, less in the way of taxes, any asset, any income stream, whether it's a dividend income stream, capital gains on turning over, your portfolio, et cetera, is more valuable to you. And so it's like lowering interest rates. House prices, generally tend to go up, right? Because your cost of borrowing has come down. So that's a little bit at play here, and I'm sure that's a factor in Goldman's view. But also, I think other factors include the following. I think there's a supposition that tax cuts will stimulate economic activity, and that typically does. Whether or not it's a win or a loss over the longer term is always tougher to determine. But in the short run, it does tend to stimulate economic activity. Stimulated economic activity is likely to result in higher GDP. The U.S., the Fortune 500 in the U.S. and U.S. companies overall tend to benefit, from that. So, boom, they're making more money. So, that's a part of it. I think the bullets you have to dodge are, one of which would be what we were just talking about is tariffs and how that might hurt the economy. I think you have to think about whether those tariffs and other stimulative activities will be inflationary, therefore causing the Fed to maybe slow down, rate cuts, or the market itself, the bond market itself, to anticipate higher inflation and therefore sort of price in, longer term rates at a higher rate. Those would be negative to the stock markets. Rising rates, are honestly sort of never good for the stock market. Declining rates can be good for the stock market. It depends on why they're declining. And so that would be another factor. So again, Fed. And then, the sort of the elephant in the room, which isn't pressing any of us today, but is out there and we all need to be aware of, is the deficit. And if all of this works as the administration is predicting, maybe not forecasting, but certainly from a rhetoric perspective, predicting it will, you'll have a situation where, you do have growth. And so therefore, it's okay. And that will help with the deficit. But if it doesn't work and it proves to be inflationary or sort of, overly stimulative, and the deficit continues to grow, at some point, the bond market, will push back. We call them the bond vigilantes.
Yeah. It's a lot of interest to repay unless you inflate your way out of it, which is, I don't think anybody's going to be happy about if that happens.
No.
Now, one driver we've talked about a number of times is fuel prices, and
Mm-hmm.
Sometimes too low is not so good. I remember, it was only a few years ago when I think if you'd had a empty gallon, if you had empty tank in the back of your yard, people would have paid you to take the oil.
That's right.
Imagine
That's
that.
right.
Okay. Now we've had two huge wars. The prices, gas has somehow stayed stable. Looks like they're coming to an end. Right. We had a lot of discussion in the election about, opening up, drilling more. I think doing more. Opening up pipelines. What point is gas too low, right? And is that a good thing for us? Is that another, or is there any risk we'll return to that scenario?
It seems to be a little bit of a lower risk. So first of all, let's take a half step back here. So, the two things that are going to affect fuel prices are supply and demand, right? And supply. So we've seen, OPEC and OPEC Plus take measures to sort of maintain, but not increase or decrease supply. The rhetoric is that the U.S. is ultimately going to increase supply with our drill baby drill policy. Whether or not that all plays through, who knows? But we're certainly not going to reduce supply coming out of the U.S. So let's in the wars that you mentioned the wars, and it is truly tragic that these things are still going on, and with no clear end in sight. And so we have to be worried about that. But all of those instances have proven to be so far not disruptive at all to oil flows. So what are the things? The one other thing I think that out there that could affect supply is, again, as you go back to our early conversation about tariffs, global trade changes in the patterns of global trade, which oil can get caught up in. Could affect the flow of oil around the world. It is a global commodity, and so if you somehow impact the flow of that through tariffs, through trade, new trade agreements, new trade wars, or whatever, you could impact supply. On the demand side, if you believe, we were just talking about, Goldman's forecast of a 10% S&P, and in part that's driven by growth, and tariffs don't upset all that and stuff. You could have demand go up, as productive capacity increases. If you buy the argument that tariffs are, not likely to help the global economy, you may not see that kind of growth. So you got, sort of put it in a nutshell, you've kind of got a stable supply backdrop, probably not a ton of growth pressure that drives prices up. So the big question would be: is there a slowdown somewhere in the global economy? But particularly, the biggest weights in that are the U.S. and China that would impact demand. And if demand were to come off, you would see prices. You should see prices come down. Are we at a place where they're likely to have the problem that we had several years ago that you were talking about? I don't think so, because that was caused by a number of exogenous factors.
Yeah.
Part of that was the ports couldn't take the oil.
Right.
Right.
Well, related question. This kind of goes in the category if you can't make this up. I see the headlines: Microsoft pays to reopen the 3 Mile Island nuclear plant to run their AI, linked data centers. Okay. We've talked about AI, touching energy. Is this a headline issue, or do you think this also could fundamentally change the energy picture of the U.S. Over the next 5 years?
I'm not an energy expert, and you recall we had our friend John Bashuri come in at one of our quarterly calls to talk a little bit about energy, but we can bring him back. But what I would say is this: it seems a little early, but it does seem that there is a little bit of a fundamental change here, because it's not just Microsoft, right? We saw a number of announcements or headlines in the past few weeks about, I believe it was Amazon, also looking to secure capacity in smaller increments, closer to, similar to Microsoft, close to where they need it. So you're seeing a little bit of a trend, right? Now the question is sort of, approvals and building things, and you and I know, I mean, I think we probably both around, when 3 Mile Island was in its heyday and also had its biggest issues, right? And so we know it takes a long time. The question would be, and particularly with a less restrictive administration, could there be an increasing speed with which capacity could come online? And again, we're not talking months here, right? It takes years. But could there be a change in mindset and regulatory approach to this that you'd see more nuclear capacity? And if that happens, and the animal spirits of AI are out there, if you're getting, if you want nuclear, if you're a consumer and you're happy to have your data center being, powered by nuclear power so that your phone works faster and better, why would you object to that running your light bulbs, right? So you can see that this could potentially drive a different mindset. We know that, nuclear is far more common in Europe and reasonably well accepted. We know that there are not a lot of problems. So maybe the case there, Paul, it's a deep sector, right? And energy in particular, and getting the power produced and then getting it to where you need it, and having, transmission lines run through, your neighborhood in Westchester and my neighborhood in New Jersey. There's probably going to be a little bit of objection, and so there's a lot of impediments to this. This idea of bringing it close to the need is probably got more legs than sort of a broad brush. Oh, let's produce more nuclear power just throughout the country. Let's do small plants, and let's do them right where we need them, so we're not transmitting in over long periods. Most of those data centers are built where not a lot of people live, because you want cheap land, because you need a lot of space, and so on and so forth. So, I think you've got the makings of growth here, and the question is the time frame.
Yeah. I agree. I've heard most of these, property deals. A lot of these property deals are related to data centers. So I think our economy is going through some change, as you say. How fast? I guess the last question for you, coming really more to the core of our insurance business, is interest rates. What do they mean? We talk about the Fed fund rates, but they don't really directly impact the 10-year, but we're focused on the 10-year and the yield curve. We're coming off this record year for fixed annuity MYGA sales. I don't know what's going to happen here for the insurance industry as rates go down, if they do.
I mean, you and and our new business teams probably have a better sense on the impact on sales than I can, but I can talk a little bit about sort of the impact of the rates environment. I mean, I think we all know that to a certain degree, falling rates or lower rates, or we witness that are not necessarily great for sales. When higher rates tend to be a little bit more attractive. I think a lot gets back to what are the reasons. If rates are coming down because the economy's sputtering, probably not good, right? If rates are coming down because the Fed feels pretty good about sort of the employment and the inflation environment, that means people are doing well. So maybe the portfolio yields aren't quite as high, but if people are doing well, there's a little bit more disposable income, a little bit more thought on retirement, so on and so forth, right? So that's a scenario where a little bit lower rates probably don't hurt the business at all. Recession, probably a different story, right? If rates are staying where they are, which is I think staying in the same zip code at least, probably a reasonably likely scenario, because as we talked about earlier, you've got some upward and downward pressure here. Or if rates are up because the economy is growing sharply, and the Fed wants to kind of the Fed and the bond market want to kind of keep a lid on on things. But those are probably all good tailwinds for the industry overall, and for consumers that are investing in the products, right? I think your worst case scenario, absent a recession, your next worst case scenario is what we were talking about earlier, where the deficit starts to loom, and you have the bond market starting to really push back, on the U.S. Treasury and on the Fed, and saying, look, the 10-year is going to keep going up until you guys show us some discipline. And that's a sort of thumb your nose at the Congress too, and the administration. And that, I think initially could probably be good for products, right? Because it's truly a higher rate. But at the same time, the message that's embedded in that and the economic outcome is one of, we need to hit the brakes a lot harder. And that's not necessarily, a good backdrop. I mean, all in all, I think, what we've been talking about here is that, we kind of expect rates to be somewhat range bound. We expect the front end of the curve to continue to come down a little bit, probably not as much as people were talking about a year or two ago. We think the Fed will, chip away at it and watch what the administration's doing, watch what the fiscal side of the picture looks like, and watch the implications of that. So you'll have a normalization of the yield curve where the front end comes down, the back end, the 10-year and beyond sort of, kind of, if you will, stay up. So you have an upwardly sloping yield curve. We don't see a lot of rise, at least in the near term, but we don't see a lot of pressure that the intermediate and longer part of the curve comes down a lot.
Yeah. Well, hey, David, listen, thanks so much for your time. Is it fair to say that you are cautiously optimistic heading into 2025?
I think that's right. I mean, there's always some things to look out for. And I think one of the things to keep in mind, Paul, we've grown accustomed to a much, much higher level of volatility because it's been out there for a while. And I think people who, haven't been around the markets don't realize, when we saw sort of the rate moves around the election and things like that, these are big swings. And when rates are moving 25 basis points, that's a big number. That's not typical. Again, we've been living with it for a while, really ever since COVID, because you had all these kind of weird things, in big shocks. But, and then if you remember when we had the little mini banking crisis, we saw the rates, drop, dramatically over a short period of time, things like that. So you're still at a much heightened level of volatility. And so that sort of underscores the cautious part of the cautiously optimistic, because things can turn quickly when you're in an environment like that. So yes, we are cautiously optimistic, but you're constantly looking over your shoulder.
Yeah. All right. Well, David, thanks for your time. Hope all the listeners get as much out of these as I certainly do. And we'll look forward to talking to you the first quarter of 2025. Imagine that.
Yeah, exactly.
Okay. Hey, thanks so much, David.
Okay.
Thank you.
Thank you, Paul. Bye.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Spotify, or wherever you get your podcasts. You can also get more information or listen to more episodes at thatannuityshow.com. Nassau Financial Group is always working harder to be your carrier of choice. We build products that help protect people's savings and are dedicated to providing you with best-in-class service. We seek to keep things simple and have your back in the years to come. Nassau is headquartered in Hartford, Connecticut. Learn more at nfg.com.
Zinnia, an Eldridge Industries business, simplifies insurance. It delivers comprehensive solutions for the industry's most critical needs and creates the modern rails of the insurance industry. To learn more about Zinnia, please visit zinnia.com.